What does it mean to be investor ready? Does your business actually need external capital right now? Do you know how much you need and what you need it for? Who owns equity in your business right now? And if you don't know your numbers, why should they trust you to manage their money? Raising money is not a milestone, it's a responsibility. Investor ready. Chances are you've heard this phrase a lot. Maybe you spoke to an investor or an angel, and at some point they said to you, you need to be investor ready. You probably nodded and then went home and couldn't figure out where to begin or what to actually do about it. So, what does it mean to be investor ready? For most people, the truth is you're actually closer than you think. You just need to put a few things in place and do some refining, and then you'll be ready to go. You don't always need to build more traction or grow your business. You just need to put what you already have together in a clearer, more concise manner. By the end of this video, you will know exactly what it means to be investor ready, and you'll walk away with a checklist to guide you through the process and help you identify your gaps and what you need to do to cover those gaps. I'm making this video specifically for the women who constantly feel like they need more traction. As women, it's easy for us to shift the goalposts. We make $4,000 in sales, then we tell ourselves we need 10,000 or 50,000 before we're ready to talk to investors. Meanwhile, you're already ready. My hope is that you stop shifting the goalpost and instead learn to present what you've already achieved, your idea, your product in a clearer manner, and master the language of how to communicate with investors. Before we get into the checklist, two important questions for you. Number one, does your business actually need external capital right now? Here's why I'm asking. Raising money is not a milestone, it's a responsibility. You are selling a piece of your company permanently in exchange for speed. That makes sense if speed is what you're missing, if you have strong reasons, or if you actually need the capital. But if your real bottleneck is other things that you're trying to mask with capital, it's not going to fix it. You're just going to scale your problems faster. I made a separate video breaking down when to know it's time to stop bootstrapping and raise capital. If you're not sure where you are right now, I suggest that you watch that one first. Number two, do you know how much you need and what you need it for? Do you know the type of funding that's best for you in this stage of your business currently? This is where a lot of founders get stuck. I also made a video mapping out different funding options for different founders at different stages. You should check that out too. Now, before we go deeper, let's quickly cover funding stages. If you've read fundraising announcements, you've probably seen words like pre-seed, seed, Series A. These are just names that are given to funding rounds. They are not set in stone. They are descriptors that help you find the right type of investor, depending on how much you are raising and what stage you are at. Pre-seed is usually the first check a company receives from external investors, sometimes an angel round or the round after friends and family. At this stage, you have an idea, maybe a little traction, maybe an MVP, that's your minimum viable product, and you want to accelerate what you're doing. Seed is next. Here, you've already answered the fundamental questions. You're clear on who your customers are, and you've made some revenue. Your product is in the market and you need capital to expand. You're more mature, more serious, and you'll probably be raising on a SAFE, that simple agreement for future equity, or a convertible note. Basically, you are signing an agreement to give away proper equity in your business in the future, not right now. Then you have Series A. At this stage, things have really progressed. There's serious price discipline. These are later stage growth investors who come to invest at this stage, and they will look closely at your numbers, what it costs you to acquire each customer, and they'll also be strict on pricing. Valuation here is usually derived from financial metrics, not through negotiation as in the earlier stages. Series B, C, and onward are similar in terms of discipline and information required, and by then you'll probably already have a CFO and a proper leadership team. If you're watching this video, you're probably at pre-seed or seed, so I'll keep everything I'm saying here focused on getting you investor ready at this stage. At pre-seed, investors are backing two things: the founder, that's you, and the idea. That's the problem you're solving. That's what you're majorly being assessed on here. So let's go into what you need to present to help them gain conviction and eventually invest. What does it mean to be investor ready? It means being in a position where your business is professionally structured enough to receive external capital. That's it. It doesn't mean impressive, perfect, or that you've made hundreds of thousands of dollars. It means structured enough that a professional investor can move from I like this to let's invest without hitting friction along the way. Friction is what kills deals. If an investor asks you for information and you can't provide it immediately, their interest cools, and that inertia is what ends up killing the deal. So these are the things that you need in place, ideally before you start talking to investors, so you can present it to them the moment that they ask. Number one, legal. Your legal structure needs to be in place. You need the right legal structure, something people can actually invest into. You might need to incorporate or reincorporate. A lot of founders start out with sole trader businesses or a small entity or a simple entity because that's easiest for them on day one. That is fine, but you need to know that that may not be what helps you fundraise. Once you're ready to raise, figure out where to incorporate, what type of entity you need, and what type of corporate structure fits. Different jurisdictions have different rules, and your structure depends entirely on where you are incorporated and where your investors are based. A US VC fund, for example, typically invests only in a Delaware C Corp because that structure has standardized, well understood mechanisms for issuing preferred shares, managing a cap table, and eventually exiting. That's why many startups worldwide incorporate in the US to make themselves attractive to US investors. A UK investor or angel investor who wants SCIS or EIS tax relief would want you to be incorporated in the UK to access that. Get the jurisdiction wrong for the investor base that you're targeting, and you will have a difficult time raising from them. Choosing the right long-term structure matters, and it is worth working with a professional to get it right. I'll link a few companies that can help you with the process, but ultimately, I recommend talking to a lawyer who is well versed in these matters. Now, the other part of legal is ownership. Who owns equity in your business right now? If you have a co-founder or you've received money from family, friends, or angel investors, is there a clean, up-to-date record of ownership, how much people have invested and how much they own? That's your cap table. Do you have documented agreements, shareholder agreements, co-founder agreements, clear records? An investor will ask for this in due diligence. If you have to start drafting and signing agreements when they ask, you're creating barriers for yourself that don't need to exist. Number two, finance. You need your financial record and projections in order. That means you need to have historical records, bank statements, revenue and profit and loss statements, projections showing your expected revenue and costs. Beyond that, you need to know your key metrics really well. This differs business to business, but examples you can include LTV, lifetime value, what a customer is worth to you over your whole relationship with that customer. CAC, cost of acquisition cost. That's what it costs you to get a customer in the first place. Churn, how many customers you are losing and how fast. Gross margin, whatever else is specific to your business model. For example, for a subscription brand, that might be retention rates. For a physical product brand, that might be reorder rates. These are all the things that you need to include. This matters because if an investor asks a numbers question in a meeting and you fumble it or say, let me get back to you, it signals that you don't have a firm grip on your own business. And if you don't know your numbers, why should they trust you to manage their money? Number three, your story. What story are you telling about the problem you're solving and why you're the best person to solve it? You need to sell yourself because investors aren't just backing an idea. They are backing you specifically to execute it better than anyone else could. If you have a specific edge, if you've lived the problem that inspired you to start the business, or you have experience that makes you one of the best people in the world to build what you're building, then let the investor know. It needs to shine through your story. You need to tell the story of the problem you're solving, why you're solving it now, and what the future looks like if your business succeeds. The numbers we mentioned earlier feed into this story, but they are not the story itself. A slide deck that's full of stats with no narrative, it does not move anyone or create an emotional connection. At the earlier stages, an investor is backing the idea and backing you. So you need to connect with the investor on an emotional level. The story is what makes someone care in the first place, and then the numbers give it weight. This story usually lives in your pitch deck, your memo, or both, and they say the same thing through different lenses. I'm going to do a full video on everything you need to have in a pitch deck. So if you're not subscribed to this channel, now is a good time to do so. Number 4, your data room. You need a single source of truth, whether it's Google Drive or DocSend, whatever you use, it doesn't matter. But you need to have a folder where every document from the first 3 sections that we've mentioned lives. You need to have your legal documents, your financial records, your deck, your memo, your cap table, any key contracts. Basically, anything about your business that you are sharing needs to be in here. You need to organize it the way you would want to receive it as an investor. Use clear file names so people know what they are looking at. If it's not obvious where something lives, an investor doing due diligence will assume you're disorganized. So you need to put your best foot forward. In the description box below, I've included a checklist for your data room outlining everything that needs to be included. So download that. Number 5, this one isn't strictly about being investor ready, but it's an important part of the process. This is your target list. I always recommend that founders build a list of specific investors to approach and not wing things. Building this properly ensures every investor on your list has actually earned their place. You need to research them, check out their thesis. Do they invest in your category, stage? Do they write the check size that you need? Do they invest in your geography? Check whether they will add value to you beyond capital. Look at what else they've invested in. Find out what you can about them online, the name of their fund, the types of companies they back, their LinkedIn, whether you can identify partners and that fund and find them on LinkedIn. You can use tools like Clay to source them and then use that for your outreach and cold emails. I'm going to do another video on how to run a tight fundraising process and what your cold emails to investors should look like. Going through this exercise, having your legals in order, your finances in order, your story, your data room, and your target list on lock is genuinely the most important thing you will do before you start talking to investors. I hope this video has helped you understand the basics of what you need to have in place to be seen as investor ready. Drop a comment with any questions that you have and I'll answer them. See you in the next video, and don't forget to like this video and subscribe to this channel.